Let me tell you something that will genuinely mess with your head. Right now, somewhere on a trading floor, a number is changing. Billions of dollars, gone, evaporated. The news anchors are pale. The Chirons are screaming. Twitter is on fire. And ordinary people, people who worked hard, saved carefully, and trusted the system, are watching their retirement accounts bleed out in real time. But here's what nobody on that news broadcast will tell you. That money was never real, not a single dollar of it. And once you truly understand why, not just the surface level, oh, markets go up and down explanation, you will never look at a stock market crash the same way again. You'll stop panicking. You'll start thinking clearly. And you might even start making money because everyone else around you is losing their mind. Stay with me, because this gets deep. I want you to imagine a town. Let's call it Millfield. In 2019, Millfield is booming. New businesses opening every month. Young families moving in. Property prices are climbing. Your house, which you bought for $200,000, is now worth $340,000. Your neighbor just sold his for $350,000. You feel wealthy. You feel secure. Then a factory closes, then another. Jobs leave. People leave. Slowly, quietly, Millfield starts to hollow out. By 2021, your house is worth $180,000. Here's the question. Where did your $160,000 go? Did someone steal it? Did it get transferred to another account somewhere? Is it sitting in a vault beneath a bank? No, it never moved anywhere because it was never really there. What you lost wasn't money. What you lost was an expectation, a collective agreement between you, your neighbors, potential buyers, and the market about what something was worth. The moment enough people changed their minds, the number changed. Just like that. No physical transaction, no vault being emptied, just a shift in belief. This is the single most important thing you need to understand about stock markets, and almost nobody explains it this way. Value isn't a fact. Value is a vote. So let's talk about how a stock price is born and how it dies. When a company lists on the stock market, it's essentially saying, we're opening our ownership up to the public. Come buy a piece of us. Those pieces are shares, and from the moment they're listed, their price becomes a living, breathing, constantly shifting reflection of what millions of people believe that company is worth. Not what it is worth, what people believe it's worth. Every second the market is open, buyers are placing bids, the price they're willing to pay. Sellers are listing offers, the price they're willing to accept. The exchange matches them automatically, algorithmically, at blistering speed. And whatever price the last trade happens at, that's the share price. That's the number you see on your phone. Now here's where it gets interesting. That price isn't just reacting to reality. It's reacting to stories about reality. A company posts slightly better earnings than analysts predicted. Price jumps 8%. A rumor circulates that a competitor is about to release something better. Price drops 5%. A CEO tweets something cryptic. Price moves before anyone even knows what it means. We like to think the stock market is this precise, rational machine. It's not. It's the world's largest, fastest, most expensive sentiment poll. And sentiment, as anyone who's ever been in a relationship or watched a sports team or lived through a pandemic knows, is deeply irrational. So what actually happens during a crash? Let's set the scene. Markets have been climbing for years. Optimism is everywhere. Valuations are stretched, some would say dangerously so. And then something happens. It doesn't even have to be that big. A surprising inflation report, a geopolitical flare-up, a single company that disappoints. One domino falls, and then the most dangerous force in finance takes over. Fear, not calculated risk assessment, not rational portfolio rebalancing. Pure, primal, get me out now fear. The first wave of sellers hits the market. Prices dip. That dip triggers automated trading algorithms, programmed to sell when prices fall past certain thresholds. More selling, more falling. Now the financial news channels pick it up. Chirons start flashing, billions wiped, trillions lost, and suddenly, millions of ordinary investors, people who had no intention of selling, are staring at their screens and thinking one thought, what if it keeps going? And so they sell too. This is the feedback loop that turns a correction into a crash. It's not economics. It's psychology. It's the same reason a crowd stampedes, the same reason bank runs happen, the same reason people buy all the toilet paper when there's a shortage. We are, at our core, herd animals. And when the herd runs, even the rational ones run with it. The Great Depression of 1929 wasn't caused by businesses suddenly becoming worthless. It was caused by panic, by margin calls cascading through a system nobody fully understood, by people selling at any price just to get out. And in that panic, real money was destroyed. People who sold at the bottom locked in losses that took decades to recover. But the people who held, who gripped the armrest and rode it out, history rewarded them. Here's what the financial media will never lead with, because calm doesn't get clicks. Every single major market crash in history has been followed by a recovery. Everyone, 1929, 1987, the dot-com bust, 2008, the COVID collapse of 2020. Every single time the market fell off a cliff, everyone declared it was over, and then it climbed back up, usually higher than before. Now look, I'm not saying crashes don't hurt, they do, especially for people who are forced to sell at the wrong time, especially for people close to retirement, especially for people who had too much risk in their portfolio and not enough cushion. This isn't some breezy, don't worry about it take, but if you have time on your side, crashes aren't disasters, they're discounts. Think about it this way. If your favorite restaurant suddenly slashed its prices by 40%, you wouldn't stay home, you'd go more often, you'd bring friends, you'd order the expensive thing. The stock market crashed and did the exact same thing, slashed the price of ownership in some of the world's most powerful companies, but instead of lining up, most people ran away. That inversion, that complete backwards reaction, is why most ordinary people build wealth slowly, while a small number build it quickly. The ones who move toward the crash, carefully, intelligently, with money they can afford to keep invested, those are the ones history keeps rewarding. Now let's talk about the present, because the signals are loud, if you know how to read them. We are sitting inside what many serious analysts believe is an AI valuation bubble. Companies with minimal revenue are being priced as if they'll own the future economy. Sound familiar? Because it should. It rhymes, uncomfortably, with 1999. Meanwhile, unemployment is quietly climbing. Wealth inequality has reached levels that historically precede major economic disruptions. Geopolitical tensions are reshaping trade routes that the global economy spent 30 years building. And tariff policy, at least from certain major economies, is being used as a political weapon in ways that make supply chains deeply unpredictable. None of this means a crash is imminent tomorrow. Markets can stay irrational longer than anyone expects. But it does mean the conditions exist. The kindling is there. All it needs is a match. And when it comes, because it will come, in some form, at some point, the people who understood why crashes happen will be the ones positioned to respond with clarity instead of panic. So what do you actually do with all of this? First, and I cannot stress this enough, do not make financial decisions based on news headlines. Headlines are optimized for fear. Fear gets clicks. Clicks sell ads. The financial media's incentive is not to keep you calm and rational. Understanding that alone will save you from 1,000 bad decisions. Second, think about your relationship with time. Stock market investing is a game where time is your greatest asset. The longer your runway, the more crashes become irrelevant. A 30-year-old investing through 3 crashes is almost certainly going to come out well. A 60-year-old who has everything in equities with no buffer is in a genuinely different situation. Third, and this is the method I personally use, consider consistency over cleverness. I invest a fixed amount every single month. Market up, market down, it doesn't matter. This approach, called pound or dollar cost averaging, means I naturally buy more shares when prices are low and fewer when they're high. It removes emotion from the equation entirely. I stop trying to predict the market and start trusting the process. I also run my personal finances on a split. Roughly half goes to essentials, housing, food, bills, the non-negotiables. A chunk goes to life, travel, experiences, things that make the days worth living. And a committed portion goes straight to investments, non-negotiable, before I can talk myself out of it. I want to be clear. I'm not a financial advisor. None of this is personal financial advice. This is just how I think about it, explained as clearly as I can. Here's the last thing I want to leave you with. The stock market is not a machine. It's a mirror. It reflects what millions of people believe about the future, their hopes, their fears, their greed, their panic. When you understand that, you stop being a passenger in that story and start being something else. An observer, a thinker, someone who can look at a crashing market and ask not, how much have I lost? But what is this telling me? And what should I do next? That shift from reactive to deliberate is worth more than any hot stock tip. Think clearly, stay curious, and don't let the headlines make your decisions for you.